So, your lender cleared you. You celebrate. Then the HOA drops a special assessment that costs more than your used car. It's real. It's happening. And no, it's not rare when reserves are weak. We're breaking down the due diligence nobody does. Reserve adequacy, fee increase history, and why state rules, from safety inspections to insurance shocks, can make next year's dues bigger. Plus, the only fee negotiation that actually works, getting the seller to pay your first year. Stick around and I'll hand you a checklist that turns mystery math into a yes or walk decision. Before we move on, please take a moment to subscribe to the channel and like the video. You see $275 a month and think, cool, gym, lawn, pool, maybe a clubhouse with a thermostat from 1999. But the line item that ruins budgets isn't monthly. It's the surprise with 5 digits that lands 2 summers from now, long after the housewarming balloons have deflated. That's the special assessment. It doesn't ask, it announces. Here's the thing. Your monthly dues keep lights on and grass cut. Reserves are the stash for roof jobs, elevator rehabs, repainting the whole complex, and structural fixes. When reserves are thin and projects come due, the board has one lever: bill the owners. You. The check shows up with a due date and a polite letter. Low dues didn't save you, they set you up. But here's the catch. Sellers love to say stable community. Listing agents love low HOA. Sounds like a win. In an inflation year, low can mean not keeping up. Materials jumped, labor jumped, insurance jumped. If the reserve fund didn't move with it, the gap didn't disappear, it grew teeth. So you don't guess. You demand the paperwork like a boss. Ask for the last 2 to 3 years of budgets, and not the glossy version, the version with line items. Get the current year-to-date financials to see reality, not promises. Pull the reserve study, full or the latest update, plus the actual reserve fund balance today. Request the aging report on payables to spot unpaid bills stacking up. Grab the insurance declarations to see premiums and coverage levels. Read board meeting minutes for the last year. They leak the truth. And ask for the history of dues increases for at least 3 to 5 years. If anyone hesitates, that's data too. Simple analogy time. Reserves are your car's emergency fund. No savings, bald tires, winter roads, tow truck. That tow truck is the assessment. You can pretend the weather is fine. The tires don't care. Why this matters right now. Inflation plus deferred maintenance equals catch-up funding. Boards that froze, dues to look friendly now face real prices. Then state mandates stack on top. After the Surfside collapse, Florida rolled out strict structural inspections and bigger reserve requirements for older buildings. Result? Fees spiked, sometimes nearly doubling for condo owners, and even small units jumped into the high hundreds monthly. In the same storm, some communities saw insurance premiums jump by triple digits, forcing higher dues to keep coverage. Out west, California associations took insurance hits as premiums multiplied, 3 to 5 times in some cases, tied to wildfire risk. When insurance alone eats the budget, guess who fills the hole? I've seen buyers focus on granite counters while the minutes hint at concrete spalling and elevator modernization. That's the board whispering, we need cash soon. The reserve study makes it louder. Scan the 5-year capital plan. If it shows roof replacement, elevator overhaul, exterior paint, or structural work due inside that window and the percent funded is weak, the math points one way. So build a simple heuristic. Low reserve percent funded plus near-term capital cycles equals high risk. You don't need calculus, you need sequencing. What's due, when, how much cash on hand, and how fast dues have climbed to keep pace with inflation and insurance shocks. Flat dues in a rising cost environment are not a flex. They're a lull before a bill. Your mini payoff right now is the demand list. Budgets, YTD financials, reserve study, current reserve balance, payables aging, insurance declarations, meeting minutes, dues increase history. That pile reveals whether the hidden bill is already brewing. If the reserve study screams major project and the bank balance whispers we're broke, you've got your answer. Now that you've got the files, let's decode the numbers so you're not guessing with your mortgage on the line. If the reserve study reads like IKEA instructions, here's your shortcut. 3 numbers. That's it. They tell you if a $15,000 hit is pacing outside your door like a debt collector with sneakers on. Let's set the board. We're checking percent funded, the upcoming project's timeline, and the fee increase history compared against the real-world bullies, inflation and insurance shocks. These aren't abstract. They decide whether your dues glide or jump. Boards love to say, "We'll catch up next year." Cute. Prices don't wait. Labor contracts reset. Materials reorder at today's costs, not last year's wish list. And lenders pay attention too. If the association's reserves look anemic, some lenders back away or demand extra docs, which can stall your closing or narrow your financing options. Low percent funded is not just risky, it's contagious. Step 1 is percent funded. Plain English. What you have in reserves divided by what you should have saved by now, based on the reserve study's useful life and remaining life for each big component. Under about 30%? Danger zone. Expect special assessments or sharp dues hikes when anything big comes due. Between 30 and 70%? That's the watch list. You might skate by if projects slide or inflation cools, but don't count on it. Above 70% feels healthier. Not bulletproof, but the odds of a surprise bill drop fast. This metric is the closest thing to an early warning siren. Step 2 is the timeline. Open the reserve study and zoom in on the next 1 to 3 years. Roof replacement, elevator modernization, exterior paint, structural repairs, concrete, balconies, decks, siding. If any of those sit inside that window, compare the estimated cost to the actual reserve balance today. If the project eats most of the fund, the shortfall lands on owners. Boards can delay paint. They can't ignore a failing roof or an elevator that keeps tripping service calls. Near-term cycles plus skinny cash equals predictable pain. Step 3 is fee history. Pull 3 to 5 years of dues increases. Flat dues during a high inflation stretch is not a flex. It's deferred pain. If costs jumped but dues did not, the gap went somewhere. Usually into a shrinking reserve contribution, which means the reserve percent funded drifted down while the project costs marched up. Watch for a pattern. Tiny bumps that don't match insurance increases or vendor contracts. That's a budget whispering future hikes. Now layer in state risk. In Florida, structural inspections and tighter reserve rules for certain buildings reset the math. Associations that coasted now have to actually fund big-ticket items, and that can override any local optimism. In California, wildfire exposure has pushed some associations into insurance premiums that multiply, which rearranges the whole budget. When insurance eats the spread, reserves get starved, and the next capital project becomes an assessment candidate. Local vibes don't beat regulatory and market changes. Here's your negotiation truth bomb. You can't bargain down monthly dues. Not a thing. But you can ask the seller to prepay 6 to 12 months of dues, or push for a closing credit size to the upcoming increase the board already telegraphed in meeting minutes. That buys breathing room while you absorb the hit or plan your exit. You've got the math and the moves. Let's lock in your yes or walk decision.